Have you ever wondered, why do some people spend their entire lives working hard and still never achieve financial freedom, while others seem to make just a few smart decisions and suddenly find themselves living with ease, letting their money work for them? Is it because they're simply luckier than the rest of us? Or could it be that they know something most of us were never taught in school, never heard in our everyday conversations? Today, I'm going to share a secret with you. Not a get-rich-quick scheme, not some magical formula, but a simple truth that holds incredible power: the difference between investing and gambling. Sounds obvious, right? But you might be surprised to learn that most people confuse these two concepts. And because of that, they're betting their financial future on emotional decisions rather than rational ones. Picture yourself walking down a bustling street, the crowd moving fast, life rushing by with every step. On your left, you spot a brightly lit booth. A smiling man waves you over to join a game using the familiar deck of playing cards. He tells you this game has been around for hundreds of years, open 24/7, always welcoming. All it takes is a single coin to play, and if you win, you get 53 coins. He says, his eyes burning with confidence. Tempting, isn't it? Now look to your right. Another booth, another card game. But something's different. No flashing lights, no shouting. The booth owner stands there quietly, calm and composed. His game looks simpler, less flashy. Each bet also costs a coin, but the prize is just 50 coins. Less exciting, right? But something about this booth keeps pulling your gaze. At first glance, both booths seem almost identical. But you know what? It's that tiny, almost invisible difference that could determine whether you become financially free or spend your life chasing money in vain. And that's exactly what we're going to uncover today: the subtle, but incredibly important, difference between investing and gambling. Not just through theory, but through real stories, costly lessons, and practical tools you can use right now to shift from being a random player to a knowledgeable investor. So, what's really happening behind the booth on the left? The one with the cheers, the glittering lights, and sweet promises calling out to you every time your willpower wavers? Let's step into that world first, to understand the true nature of gambling and why it's designed to make you lose in the long run. Let's begin with that left side booth, the one with the dazzling lights, the roaring crowd, where you're welcomed like a VIP, as long as you have money and a dash of recklessness. The booth owner invites you to play a very simple game, using a standard deck of cards. Each round, you place a one-coin bet. If you draw the same card as the one randomly picked by the house, you win and take home 53 coins. Sounds amazing. One coin for 53? Who wouldn't want to try? And the best part? You don't need any knowledge. No need to understand business, the economy, or the market. Just luck. The game is quick, easy, and thrilling. But do you know what your odds of winning that game are? Just 1 in 52, less than 2%. That means if you play 100 times, you'll lose 98 or 99 times. And you know what's worse? The moment you win once, your brain starts to believe you're on a lucky streak. It urges you to keep playing, to bet even more. You get caught in a spiral of emotion, excitement, then regret, then hope, and you keep going, trying to win it back. That's the true nature of gambling. It doesn't just take your money. It hijacks your emotions and clouds your logic. You think you'll stop after a few losses? Think again. You'll tell yourself, just one more round, and I'll win it back. And so, you keep playing, keep hoping, until your wallet's empty before you even realize it. The danger of gambling doesn't lie in how much you bet each round. It lies in the psychological trap it sets for you. The rush of flipping a card, the joy of winning. It floods your brain with dopamine, creating the illusion of victory and luck, even though statistically, the house always wins. And don't be fooled. Gambling isn't limited to casinos or slot machines. Today, gambling hides under many modern disguises, from buying a stock just because someone told you to, without knowing anything about the company, to chasing the latest trend, hoping for a quick flip and fast profit. When you put money into something you don't truly understand, that's no longer investing. That's gambling, dressed up in a fancier, more sophisticated outfit. Remember this: gambling is a game where, over time, you are almost guaranteed to lose. Why? Because it's designed that way. The house always has the edge. The system is built in their favor, and they're not afraid of players who stay at the table. The only kind of player they fear is the one who knows when to walk away. But honestly, how many people can truly do that? How many of us really know when to stop? When we're winning, we want more. When we're losing, we want to win it back. That's the vicious cycle most gamblers fall into. Gambling isn't just about money. It's a battle with your own emotions. And the sad truth is, most of us lose that battle. Not because we're stupid, but because we're human. We have emotions, desires, fears, and gambling plays right into those. Sure, you might win once, maybe twice. But in the long run, the rules of the game will crush you. No strategy, no knowledge, no advantage means you're just leaving it all to chance. But if gambling is the road to guaranteed losses, then what exactly is investing? Is it just a more sophisticated version of gambling, dressed up in different language and scale? Or does it have a fundamentally different nature? A game where, if you know how to play, you can actually win? Let's step over to the booth on the right, the one with fewer promises, but hiding a secret quietly practiced by the greatest investors of all time. Now, let's return to that right side booth, the one without pounding music, without flashing lights, and without any bold claims of life-changing wins from a single hand. At first glance, this place might seem boring. The reward for winning is just 50 coins, 3 less than the other side. They even remove a few cards from the deck. You might ask, why would they do that? Isn't that cheating? No, it's not cheating. It's the mindset of an investor. They eliminate the biggest risks, the worst cards, to increase the odds of winning over the long run. They accept smaller short-term rewards in exchange for a lasting long-term advantage. And that's the essence of investing. No flash, no emotion, no promises of instant results. But if you're patient, if you know what you're doing and you have an edge, then success becomes almost inevitable. Imagine you're playing a coin toss game. If it lands heads, you win $1. If it lands tails, you lose $1. Sounds fair, right? But what if someone told you, this coin has a 51% chance of landing heads? With just that tiny advantage, if you play the game long enough, you'll end up with massive gains. That's the core principle of investing. Probability edge plus time plus discipline equals success. But here's the thing. How do you even discover that 51% coin? You need knowledge. You need analysis. You need to see how the system works behind the scenes. And you need patience, not to quit halfway through just because of a few short-term losses. This is the exact opposite of gambling, where every outcome hinges on luck. In investing, you're not stuck with 1 in 52 odds like in that card game. You get to choose the game where the odds are stacked in your favor. Take a look at legendary investors like Warren Buffett. Do you know what he once said? If you're not willing to hold a stock for 10 years, don't even think about holding it for 10 minutes. Investing isn't about buying today and selling tomorrow. It's about committing to real value for the long haul. When you buy shares of a company, you're not just buying a piece of paper with a fluctuating price. You're buying a piece of the business. And if that business grows and creates value, your wealth will grow alongside it. On the other hand, if you know nothing about the company, what it does, who it sells to, how it makes money, you're not investing. You're gambling on something you don't understand. And that takes us back to square one. Picture yourself standing before 2 choices. 1. Buy stock in a company you know absolutely nothing about, just because the price is going up. 2. Invest in a business you've spent time researching, reading financial reports, understanding the product, analyzing its growth potential and leadership team. Which one would you choose? If you pick the second, you're already halfway to becoming a real investor. And here's the beauty of it. You don't need to be a genius to succeed in investing. Charlie Munger, Buffett's longtime partner, once said, most people who do well have 3 traits: intelligence, hard work, and a bit of luck. But if you start early and stay persistent, you'll end up with at least one of those. You can't control luck, but you can learn. You can stay disciplined. You can be patient. And those qualities create the lasting difference between investing and gambling. One of the most important truths is this: investing isn't always exciting. It's not like the adrenaline rush of a casino or the thrill of buying a lottery ticket. In fact, sometimes investing is just boring. You'll spend hours poring over financial statements. You'll dig through dry numbers. You'll track macroeconomic trends that don't seem relevant to your daily life. But it's through that boring process that you build deep understanding, the kind of understanding that helps you make the right calls when the market turns chaotic. And when the market panics and everyone's selling, you stay calm. Because you're not betting on price. You're trusting in value. Investing is a psychological game, not for the emotionally impulsive. In the short term, the market is a voting machine where prices are driven by emotion. But in the long run, it's a weighing machine where real value always wins out. But all of this, these ideas, this mindset, this philosophy, does it actually hold up in the real world? Let's move on to the next chapter, where we'll look back at the history of investing, at the crises and chaos, and the incredible opportunities that emerged from them. Because sometimes, it's in the moments of deepest fear that the smartest investors begin to act. We just said that investing is a game of insight, where value will shine through in the long run, no matter the short-term noise. But is that really true? Or is it just wishful thinking spun by people who've never felt the pain of a crashing market? The answer lies in history itself, a place where the market has plunged again and again, where fear has swallowed the financial world whole, and yet, in the darkest hours, once-in-a-lifetime opportunities have appeared. Let's go back to 2008, the global financial crisis. The U.S. stock market went into free fall. The Dow Jones plummeted from over 14,000 points in October 2007 to around 6,500 in March 2009, a drop of more than 50%. Millions panicked. Investment funds fled. The news was flooded with doom. Banks collapsing, markets freezing, economies crumbling. In the middle of that storm, everyone was focused on just one thing: sell. Sell as fast as possible. But guess what? The brave ones who bought when the markets were drenched in red. Those who understood that stock prices were falling not because businesses were failing, but because the crowd was ruled by fear. Those people became the great winners of the next decade. From the bottom in 2009, the Dow Jones didn't just recover, it surged for years. Those who bought when everyone else ran away saw returns in the hundreds, even thousands of percent. And 2008 wasn't the only time. Look at 2020, when the COVID-19 pandemic broke out. The world shut down. The economy stalled. Once again, the stock market plunged. In just weeks, high-quality stocks fell 30 to 40%, sometimes even more. People panicked again. People fled again. But a small group, those who were prepared, who kept a cool head and a long-term vision, understood. The pandemic would pass, people would adapt, and good companies would recover. They bought stocks at irrationally low prices. And what happened? Take Apple, for example. Its stock dropped from $80 to around $55 in March 2020, but by the end of 2021, it had skyrocketed past $180. That's a gain of over 200% in less than 2 years. All of these stories tell us one thing loud and clear. In investing, crowd emotion is your biggest enemy. And history always rewards those who stay rational when chaos reigns. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." It sounds simple, but doing it? That's another story. Because when the market is deep in the red and your portfolio is bleeding, you'll feel the urge to do something, usually to sell in a panic. But if you understand the business behind the stock, if you know that a falling price doesn't change a company's real potential, you won't be afraid. On the contrary, you'll be glad you can now buy a great asset at a discount. Imagine you love a car that costs $1 billion VND. Suddenly, one day, the showroom announces it's been marked down to $700 million. What do? Walk away because the price dropped? Or jump at the chance to buy? Yet in investing, when stock prices fall, people run, instead of seeing opportunity. Vietnam stock market has had moments like that too. In 2022, the VN Index fell from nearly 1,500 points to just 900 in a matter of months. Panic selling reached its peak, and individual investors lost faith. But look again, by 2023, the market began to recover, and those who stayed firm in their belief in valuable businesses reaped the rewards. Of course, no one can perfectly predict the market's bottom. But the good news is, you don't have to. You just need to understand one thing. In chaos, when everyone else is lost, that's when the market gives you the rare chance to buy great assets at bargain prices. And here's a sobering truth. History doesn't repeat itself exactly, but it often rhymes. The dot-com bubble in 2000, the financial crisis of 2008, the global pandemic in 2020. Each event was different, yet the underlying rhythm of the market remained the same. Greed, fear, recovery, and growth. Those who don't study financial history are doomed to repeat its mistakes, selling in panic, buying in too late. But those who learn from history understand this. The greatest opportunities don't come when everything is calm. They come when everyone thinks the world is about to collapse. So, if you've come to realize that chaos often brings opportunity, if you now understand that markets aren't always rational, then the next question becomes, how can you invest intelligently and systematically? Are there guiding principles? Is there a clear strategy that can help you stay grounded no matter what the market throws at you? Let's move on to the next part, the 9 core principles that will help you become a true investor, so you can not only survive a crisis, but rise stronger from it. We've just looked back at history and seen this. The most successful investors aren't the ones who can predict the future. They're the ones who stay calm, think independently, and act with discipline when markets are in chaos. But how can you, an ordinary person, invest as wisely and effectively as they do? The truth is, investing doesn't require you to be a genius. You don't need a PhD in economics or a supercomputer. All you need is to stick to a few simple, fundamental principles and commit to applying them consistently over time. Not everyone will become Warren Buffett, but if you take seriously what I'm about to share, you'll build a solid foundation for lasting wealth. Even if you're starting out with just a small amount of capital, the first principle, and the bedrock of all others, starts with something that sounds almost too simple: continuous learning. Did you know Warren Buffett spends 5 to 6 hours a day reading books and reports? Not for entertainment, but to keep learning, stay updated, and gain clearer insights into the world with every page. The market is always changing. What worked 10 years ago might be obsolete today. Companies that once led an industry can be overtaken by a scrappy new startup. So if you stop learning, the market will leave you behind. You don't need to dive into thick financial reports right away. Just spend 30 minutes a day reading an industry article, an investment newsletter, or even a chapter from a classic investing book. Over time, this simple habit will sharpen your instincts, steady your emotions, and make you far less likely to be swayed by rumors or hype. Once you've built a solid knowledge base, the next step is to go deeper. Don't just learn broadly, learn deeply, especially about the companies you plan to invest in. This brings us to the next principle: thorough research. Charlie Munger once said, "Don't buy a stock like you're buying a lottery ticket. Buy it like you're buying the whole business." What does that mean? When you buy a stock, you're becoming part owner of that company. So shouldn't you know what they sell, who they serve, how profitable they are, and whether their leadership team is trustworthy? Investing without understanding a business is like marrying someone just for their looks. Sure, they might be attractive, but can you build a life together? Read the financial statements. Understand the business model. Learn about their supply chain, risks, and competitive edge. Know where they stand in the industry, and whether they can maintain that position over the next 5 to 10 years. And when you truly understand the business, when you believe in its real value, the next step may sound simple, but it's one of the hardest to practice: patience. In a world where everyone wants to cash out in a few weeks or months, the ability to hold your conviction for years, that alone can become your greatest competitive advantage. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." If you've invested in a good company at a fair price, let time do the rest. An oak tree doesn't grow in one spring. A business needs time to execute its strategy, expand market share, and optimize profits. And the market needs time to recognize that value. But patience doesn't mean passivity. While you wait, you'll face temptations, falling prices, negative headlines, wild market swings. And that's when you'll need something crucial: discipline. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." If you've invested in a good company at a fair price, then let time do its work. An oak tree doesn't grow in a single spring. A business needs time to execute its strategy, expand its market share, and optimize its profits. And the market needs time to recognize that value. But patience doesn't mean passivity. While you wait, you'll face countless temptations: falling prices, bad news, sharp market swings. And in those moments, you need something crucial: discipline. Discipline to stay true to your investment strategy. Discipline to not panic sell just because the market's bleeding red. Discipline to avoid chasing after hot stocks you don't understand, just because you're afraid of missing out. In investing, sometimes doing nothing is the hardest move, but also the most effective one. However, to maintain discipline, you need a solid mindset. And in a market where everyone has an opinion and everyone wants to tell you what to do, you need a special skill: independent thinking. The financial market is a place where herd mentality thrives. When stocks go up, people rush in. When they go down, people flee. Forums and social media flood with rumors, charts, and advice. But here's the truth. The biggest profits often come from going against the crowd. Not because you want to be contrarian, but because you have your own reason, grounded in real understanding. Don't invest just because someone says it's a good buy. Invest because you understand why it's worth buying. And never forget, you alone are responsible for your decisions. Once you have confidence in your own analysis, you'll feel more secure in allocating your capital. But that doesn't mean you should throw it all into one stock. This is where another essential principle comes in: diversification. Even the world's best investors don't get it right 100% of the time. So, spread your risk. Invest in 5 to 10 businesses across different industries. Don't put all your eggs in one basket, because if that basket drops, you lose everything. Diversification won't make you rich quickly, but it will keep you from going broke quickly, and that's far more important. Alongside managing risk through diversification, you also need to pay attention to something that seems small, but has a huge impact on your long-term returns: costs. And by costs, I don't just mean trading fees. I mean taxes, management fees, and even hidden charges in financial products you use. A 2% annual fee might not seem like much, but over 10 or 20 years, it could eat up hundreds of millions of VND in potential gains. Choose low-cost tools, like ETFs or transparent platforms. And don't overtrade. Every buy or sell order comes with a price. Now that you've bought quality stocks at reasonable costs and built a diversified portfolio, what's next? Monitoring, but not the obsessive kind. Selective monitoring, meaning you don't need to check the ticker every minute or hour. Set regular check-ins, weekly or monthly, and only take action when there's a real change in the business or industry. If everything is still in line with your original plan, you don't need to do anything at all. And finally, the most important piece, the one that will ultimately determine your success or failure in investing, isn't your knowledge. It's your emotions. Emotional control is the final principle, and also the hardest one. You'll feel greed when others are making big profits. You'll panic when your portfolio takes a dive overnight. You'll start doubting yourself when a stock drops, even if you know the business is still fundamentally sound. Remember this: it's not the market that causes you to lose money. It's fear and greed that drive you to make the wrong decisions. Before you buy or sell, write down your reason. Then, revisit it the next day. If, after calming down, you still believe in that reason, go ahead and act. If not, chances are you were just reacting emotionally. As you can see, successful investing isn't a mystery. It's a combination of knowledge, strategy, and discipline. These 9 principles are your compass, helping you steer the ship, even when the waves are high and the winds are fierce. But no matter how powerful the theory, it's still just theory, unless you know how to apply it. So, let's move on to the next part, where we'll walk through a real-life example, applying each of these principles to a specific company, so you can see clearly. Investing isn't some distant dream. It's something you can do, starting today. Now that we've explored the core principles of smart investing, you might be wondering, what does all of this actually look like in practice? How do I know when a company is truly worth investing in? So let's do a simple but powerful exercise. Step into the mindset of a real investor and start analyzing a well-known company. Today, I'm choosing Apple. Not just because it's the largest tech company in the world, but because it's a perfect example of how a value investor can uncover real potential behind the numbers, the price swings, and even the short-term fears in the market. The first thing you need to do with any business is not to look at the stock price, but to ask a simple question: how does this company make money? With Apple, the answer might seem obvious. They sell iPhones, iPads, MacBooks, right? Yes, but that's just the surface. A value investor needs to dig deeper. Apple isn't just a device seller. It's an entire ecosystem, a tightly woven network of products and services that connect seamlessly. From the iPhone in your hand to your AirPods, Apple Watch, iCloud account, Apple Music library, Apple TV Plus shows, and payments via Apple Pay. It's all interconnected. Once you've adopted a part of that ecosystem, it becomes very hard to leave. That's when you start to realize Apple isn't just selling devices. They're building a world for their users. And when you buy shares in the company, you're buying a piece of that world. Once you understand how a company makes money, the next step is to examine its financial strength. Finances aren't just numbers to brag about. They reflect the true health of a business. And if you look at Apple, you'll see an incredibly solid financial foundation. Their revenue has consistently grown year after year, even during times of economic uncertainty. Their profit margins are high, which means they retain a large portion of revenue after expenses, a sign of strong operational control. They generate abundant free cash flow, which allows them to reinvest, buy back shares, and pay dividends, all of which benefit shareholders like you. And importantly, Apple carries virtually no bad debt. Their borrowings are mainly strategic, taking advantage of financial leverage, not because they lack cash. But numbers only tell part of the story. As an investor, you also need to look for sustainable advantages, the kind of strengths that not only help a company survive, but thrive long-term. With Apple, those advantages are crystal clear. A powerful brand, a tightly integrated ecosystem, loyal customers, superior supply chain control, and massive scale. All of it forms a deep economic moat that keeps competitors at bay. And it's exactly these qualities that make Apple especially attractive when their stock drops. Let's rewind to March 2020. The world was in a panic over the COVID-19 pandemic. Within just a few weeks, Apple stock dropped from around $80 to just above $50. Millions of people panic sold their shares. Headlines screamed financial doom. Fear ruled the market. But if you were an investor who had already studied Apple, its business model, its financial strength, its strategic vision, and its durable competitive edge, what would you see? You'd realize that this drop wasn't due to Apple performing poorly. They were still selling products, still making money, still launching new devices, still holding mountains of cash. The market's decline was driven by emotion, not a loss of value. And in that moment, you could make a decision very different from the crowd, to buy. Not because you're a risk taker, but because you understand the company. You know you're buying a high-quality asset at a compelling price. And you already know the result. In less than 2 years, Apple stock surged from just over $50 to nearly $180, a gain of more than 200%. Not because of luck, not because you caught the wave, but because you understood the business and acted when others were fearful. The best part is, you don't have to be a Wall Street expert to do this. All you need is the right mindset, the right method, and a bit of courage to go against the crowd when it counts. You might be thinking, Apple is a huge global company with teams of analysts watching it every day. Can I really apply this approach to local businesses? The answer is absolutely. You can use this exact mindset to analyze a company like Hoa Phat by looking at steel demand, raw material prices, production capacity, economies of scale, cash flow management, and how its valuation compares to earnings. Or with Vinamilk, you could study consumer trends, distribution models, export growth, and its ability to maintain market share against foreign brands. Even with tech companies like FPT, you can evaluate them based on digital transformation demand, overseas software markets, talent quality, and growth trajectory. The approach is the same. Understand the business, assess its true value, stay disciplined, and invest with confidence when the opportunity arises. None of this requires you to be a genius. All it takes is seriousness, a willingness to invest time into learning, and the discipline to tune out the noise of short-term rumors. Through the example of Apple, you can clearly see one fundamental truth. Investing is not about guessing which stock will go up the fastest. It's about deeply understanding a business, assessing its true value, and being ready to act when the market price falls below that value. And you know what? Opportunities like that aren't rare. The market constantly overestimates or underestimates the real worth of businesses. The real question is, do you have the patience to wait? The knowledge to recognize them? The discipline to stick to your conviction amid a storm of speculation? If you do, then you're already halfway on the journey to becoming a successful investor. And now, with all the theory understood, the real-life example explored, you're probably asking the most important question: where do I begin? In this final part, I'll help you summarize everything we've covered so far and guide you on how to begin your own investing journey. in a way that's simple, strategic, and deeply empowering. So here we are, at the end of a long journey we've taken together. From understanding the difference between investing and gambling, to learning the 9 core principles of smart investing, and applying them to a real company like Apple. And now, as you stand with this solid foundation beneath you, having glimpsed what true value investing looks like, one question remains. What will you do with what you've learned? This is your defining moment. Because knowledge, if left untouched, is nothing more than pretty words stored in your memory. But action, no matter how small, is the first step toward a completely different financial future. And you don't need to start big. You don't need to throw tens of millions into stocks right away. You don't need to become an expert overnight. What you need to do today is start with yourself. Before investing money, invest your time. Before investing in stocks, invest in your mindset. Start by building a simple daily habit of financial learning. It could be reading one chapter of a book. It could be analyzing a company you like. It could be listening to a podcast from experienced investors. Don't underestimate these small actions, because it's precisely the small things, done consistently, that create massive change over time. You might be thinking, I don't know much about finance, or I don't have enough money to invest. But remember, every great investor once started from zero. Warren Buffett bought his first stock at age 11, with a small sum he saved from delivering newspapers. Charlie Munger didn't come from a wealthy background. Ray Dalio began his investing journey by borrowing a few $100s to buy shares in a small store. What separated them from the majority wasn't their starting point. It was their persistence, their hunger to learn, and their relentless discipline. And you can do the same, as long as you're truly committed. You might not see results in the first few weeks or months, but that's the nature of investing. It's not an overnight miracle. It's a steady accumulation of value over time. Like planting a seed. If you water it daily, eventually it will sprout and grow into a strong tree. But if you give up just because you don't see a sprout in the first few days, you'll have thrown away the entire forest of your future. Let's recall something Buffett once said. The stock market is a wonderfully efficient mechanism for transferring wealth from the impatient to the patient. And to develop that patience, there's one core requirement: long-term thinking. Don't invest with the desire to get rich quickly. Invest with the goal of getting rich securely. Don't chase overnight success. Build toward true financial freedom over the next 5, 10, or 20 years. And if you stay committed long enough, you'll witness something amazing. Not only will your investment account grow, but you will grow. You'll become more rational, more grounded, and more composed in the face of volatility, not just in markets, but in life. Because true investing isn't just about money. It's a lesson in mindset, emotion, and inner growth. When you learn to master your greed and fear, you don't just become a better investor. You become a stronger, wiser person in all of life's decisions. And now that you've understood all this, you're probably wondering, what should I actually do right now? I won't tell you what to do, but I do have a few suggestions. Start by choosing a company you genuinely like. Maybe it's a brand you use every day. Maybe it's a Vietnamese business you trust. Begin studying it like a real investor. Read its financial reports, go through analysis, understand the industry, identify its competitive advantage. Don't rush to buy, just research. You'll start to feel a shift in how you view companies, not as tickers bouncing on a screen, but as real engines of value. At the same time, start building discipline. Set up a simple savings plan, maybe just 10% of your income every month, reserved for future investing. Start small, tiny even, but stay consistent. Investing is a journey, and every journey starts with a first step. That first step may be shaky. You may feel unsure, but the most important thing is you take it. The financial markets are like an ocean, vast, deep, sometimes stormy. But like the sea, those who learn to read the map, steer the boat, and keep their hands steady eventually reach the shore of freedom. You can be one of those people. Don't wait until you're good enough to start. Starting is what makes you better every day. Write your own legendary financial story, starting today. Be the one who takes initiative. Be the one who dares. Be the one who stays the course. Because as Charlie Munger once said, if you enjoy the work and the people you're doing it with, you'll never work a day in your life. And I'll add this, if you fall in love with investing, with understanding value, you won't just become wealthy. You'll live a life that's empowered, confident, and truly fulfilling. Now is the time to act. You've learned the theory. You've seen the real-life example. You know the path. All that's left is this. Are you ready to take the first step? I believe you are. The world of investing is waiting to be explored. The sea of finance still holds countless treasures. Not for the lazy, but for the curious, the humble, the relentless learners who believe in real value. Go forward. And remember, you don't have to walk this path alone. Thank you for staying with me all the way to the end of this video. I truly appreciate it, because I know in a world overflowing with noise and distractions, choosing to pause, listen, and learn is no easy thing. I hope these insights have given you a new perspective, a spark of motivation, or even just a small light to guide you forward on your journey to investing and financial freedom. If you found this content helpful, don't forget to subscribe to the channel, share the video with your friends, and leave a comment to let me know what you're thinking. Every interaction you make is a huge motivation for me to keep creating more valuable content. The investing journey is a long one, and I'd be honored to walk it with you. Wishing you clarity, resilience, and success always. See you in the next video.